Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show. I'm glad you've joined us today. If this is your first time listening, welcome. If you've returned to us, obviously you've got some value from it, so I appreciate that. And tell your friends about it. We do this radio show every Saturday morning. We also have a podcast, the Ask Ralph Show podcast. You can get that at iTunes or wherever you get your podcast. You can also go to our website at askralph.com. Now, today I thought I'd talk about some home ownership tax myths. There's a lot of mayhem and misconceptions flying around this year about the new tax code. And there are some things that people are saying, and I'm hearing some of them even from my own clients about some of the things that have changed. So whether you want to enter this filing season with clear-eyed confidence or just test what you know, here's a list of things that we can talk about that are tax myths. First one, tax myth number one, the mortgage interest deduction is gone. And I've heard some clients say this. It's not true. If you bought your home before December 15, 2017, you're in luck. You are grandfathered in under the old tax laws and can still deduct all the interest on loans up to $1 million. For those who bought a home after December 15, 2017 or plan to in the future, the big deal here is it's just been reduced to the cap of $750,000. So basically you can deduct the interest on a loan up to $750,000. So it's not gone. Now, we'll talk a little bit about, the growth of the standard deduction, but let's move on to the second one. Property tax deductions are gone. Again, not true. In the past, most taxpayers could deduct state, city, and property taxes in their entirety. Now, here's where there has been a bit of a change. Under the new tax plan, these are still deductible. However, there's a cap of $10,000 per year. So in other words, property tax and mortgage interest deductions are far from gone. And this is what we're talking about, the standard deduction. But one thing to consider is that the standard deduction nearly doubled to $12,000 for single filers and $24,000 for married couples filing jointly. As such, it may not make sense for any people to itemize their deductions unless it amounts to more than that higher new bar. Now, one of the things that I'm finding is you may not itemize for the federal return because of that high standard deduction, but you may be leaving money on the table especially at the state of Delaware, if you're able to itemize at the state. So it may still make sense for you to compile those itemized deductions. But again, the property taxes are not eliminated. They're just a cap. Now, this is affecting people who are high wage earners who have high property taxes, and that $10,000 cap has hit a little bit of it. Here's tax myth number three. If you work from home, you can deduct a home office. And some people think this is, some people mistakenly think that anyone who fires up a laptop at the kitchen island has a home office. But here's the thing you need to understand, and a lot of people don't get this. To take a home office deduction, that area must not only be used regularly and exclusively for business, but it also has to be the primary site of the business. So if you've turned a spare room into a dedicated workspace, you can claim it. But if you only occasionally work in the living room, that's not deductible. You also need to understand there are some very strict new tax code based on this. In the past, office employees who occasionally work from home could claim eligible home office deductions that might include, say, business expenses that were not reimbursed by your employer. But now only self-employed people can deduct their home office in that way because they've eliminated, I'm going to get a little bit into the weeds here. They've eliminated what's called the 2% limitation. Found up my words today. I apologize. On the Schedule A, the miscellaneous itemized deductions have been eliminated. And that's where people would take a deduction for those unreimbursed business expenses. So that's gone. And that's affected a lot of people. I've seen a lot of people in my practice this year who have been affected by that. Maybe they had union dues that were higher. They had mileage that wasn't reimbursed, and that's cost some people some money, but that is gone. So the tax myth is you can still deduct a home office, but you need to understand what the implications of that. Next one, tax myth number 4, you can deduct all of your home renovations. Absolutely not true. Home improvements are generally not tax deductible unless the residence also serves as a rental property. But there are a couple things that you can still deduct for home renovations. That is if the modifications were made for medical purposes that don't increase your property value. So that could be something like installing railings or support bars, building ramps, widening doorways, lowering cabinets or electrical fixtures, and adding stair lifts. Now, you're going to need a letter from your doctor to prove the modifications are medically necessary. And remember, they have to be greater than 7.5% of your adjusted gross income. Now, the other thing that you can do is you can deduct renovations if they were made in order to sell your home. But that's, again, only a deduction against any possible capital gain that you could have on the sale of your home. And, as a married filing joint couple, you have that $500,000 exclusion now. So most people don't have that much of a profit. Now, myth number 5, all home equity interest is deductible. Now, homeowners used to turn to a home equity loan or line of credit for cash to make home improvements or pay for general expenses. Maybe your child's getting married or maybe tuition. And in years past, the interest on these loans was tax deductible. But not anymore. Home equity line of credit interest is deductible only if the loan is used for a substantial home improvement. And remember, we still got that $750,000 cap. Now, to be blunt, I'm not sure how the IRS is going to police this. So from a practical standpoint, yes, you cannot deduct home equity interest unless it's used for substantial home improvement. I don't know how you would document that. And that's the fungibility of money. I don't know how you would do that. And the IRS hasn't, not that I've seen, issued any regulations. We have the Congress that creates the tax law. They push that over to the IRS that writes the tax code and writes the regulations. Well, since we've got this big tax reform that hit, the new tax rates that started, new tax plan that started with 2018, it's going to take some time for the IRS to write these regulations. Now, what I suspect is going to happen in this area, perhaps, is that when you get those home equity loans, there's going to be some sort of, checkbox or something like that where the person that's granting that home equity loan to you is paying, directly to a contractor or some sort of thing like that. That's the only way I know that they're going to be able to handle this, or it's just going to be on the, the honesty way to doing things, but that could be. Now, the final one, tax myth we're going to talk about here, and these are all related to homeownership, is you can always deduct your moving expenses. Well, that was true up until last year, where taxpayers could deduct only a portion of moving expenses when they relocated for a new job that's at least 50 miles farther from their former home and to their old job. So basically, if you moved 50 miles away. Now, that was completely eliminated with the new tax law. The only exception are members of the armed forces on active duty. So if you've moved and you are expecting to take a deduction for those moving expenses, I hate to tell you, it's not going to happen. And that's because they've eliminated that 100% this year. So, but unless you're in the military and on active duty, you can still take those things. So I hope, as we talk about these tax myths, don't always believe what you hear, because what you hear is not always true. So, you need to take a look at it and say, are these things really true? And that's why it really comes down to a great idea to hire somebody like myself that goes over this, because we know the ins and outs of this. Now, that being said, a lot of stuff is still gray this year with there not being much regulation. But these things we're very clear on. And don't listen to your friends at work or your neighbors, I did this, I did that. That's the way you're going to get yourself into a lot of trouble quickly. So I hope this was helpful. If you want to follow up with me, you can go to my website at AskRalph.com, and I encourage you to go back and listen to some of our podcasts. Again, it's the Ask Ralph podcast. So hope this was helpful.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.